Hi there, my name's Dave Tyrer. I'm the Chief Operating Officer here at Squirrel, and I'm the one who writes very long emails to you on a regular basis with the investor updates. So nice to meet you all if I haven't spoken to you either via email or over the phone at some stage. Righto, today, this session is all about Launchpad, which is a new product that we introduced just about 10 days or so ago. The session today, I've got about sort of 5 to 10 minutes worth of a few slides to talk through, and then we'll get into some Q&A. I'd expect the session will last no longer than 30 minutes, although if there's lots and lots of questions, I'll happily stay on and keep answering those as we go. Righty-ho, so let's get into it. Let's move on to our next slide. So what is Launchpad? So Launchpad is a product that we've built specifically for first home buyers. Our mortgage advisors see up to 5 billion worth of home loan applications each year, of which about 30% are for first home buyers. So we think we see a really good cross-section of different people that are aiming to buy a home in the market. What we've seen is that Kāinga Order, they have a scheme for first home buyers which helps people who are buying, I'd call it at lower valued houses. There's also the banks, they contribute, they do some of their lending between 80% and 90% LVR, and some first home buyers are able to rely on the bank of parents, so to speak. But there is a very clear gap, and that gap in the market is there is no lender out there supporting households that have high disposable income but haven't yet saved a large deposit. And if you look at rents, certainly in New Zealand's major cities today, those rents are incredibly high, which makes it very hard for people to save, and it takes them a long time. So Launchpad is designed expressly for that group. So you've got high household income, you may not have a lot of deposit saved, but you absolutely intend buying a house. And so we're going to short circuit that savings process for you and allow you to buy much, much sooner. You'll need to have a 5% deposit or more in some situations. The interest rates that we're offering are very competitive and will help you get started. You've got to be a New Zealand resident. It's not for investment property, so you need to be looking to live in it. You'll be on PAYE income, probably buying in a metro area. This one's a bit tricky to define. The closest approximation we can give is that if you live within about 10 kilometres of a McDonald's, we'll class that as metro. So metro actually is a lot broader than what some people might consider that term. And you do need to have, as I said, a 5% saved deposit. That deposit can include KiwiSaver as we go. I just saw someone popped a question in there from Steve saying I'm not on. That's okay. No problem at all. Along the way, if you do want to ask questions today, there's a Q&A box that you'll see in your little Zoom bar there. Feel free to ask questions. This could be a very boring session if you're just listening to me rabbit on for 5 to 10 minutes. So please do pop questions in there and I will endeavour to answer all of those today. Alrighty, so moving on slides. So how does the loan work? What we've done is we've split the loan, we think in quite an innovative way, into 2 portions. So we have the equity loan, which will be up to 15% of the value of the property. The interest rate on that portion is 9.95%, and it's written as a personal loan with a second mortgage attached to it. The repayments that the borrower is going to make are principal and interest. The term will be 5 years with a maximum loan size of 120,000. So what we want to see borrowers doing is paying that loan down quite aggressively. Obviously, the interest rate's quite high, and we've given them every opportunity to try and pay that loan down as quickly as they practically can. There are no penalty costs for them prepaying early. That might be a slight downside for investors because they're getting their funds back perhaps sooner than what they might have expected. However, we believe we can write more than enough loans to satisfy demand from our investors in that space. So that equity loan is the top portion of the loan that our borrowers will have. The bulk of the loan, so this is 80% of the value of the property, is funded by one of our partners. The borrowers are paying 3 to 3.5% on that loan with where interest rates are today. That loan is going to be interest only over that first 5 years. Once again, we're really trying to help the borrower focus on paying down that top part of the loan or the equity loan as rapidly as they can. This table gives you an idea of the, taking some different house price points, what the maximum LVR or loan to value ratio is that the borrower can get to, and the size of the deposit they're going to need versus the loan. So you can see at 800,000, they can get right out to a 95% LVR. As the house price that they're looking to buy increases beyond that point, they will need to have a little bit more deposit. A few reasons for that. One is that we know that if house prices start moving in a downward directions, it's more likely to hit higher valued houses before it hits lower value houses. There's always demand at that bottom end of the market for homes. So we're building in a bit more of an equity buffer, both for the borrower and for our investors. Okay, I'm going to keep moving here. So here's a real life example. And when I say real life, it's one that we've made up, but it's something that we see every day. So this might be a typical first home buyer that we see in Auckland or Wellington today. So you've got a couple, they've found a house that's worth 800,000. They've got high disposable income. So, we've said here $140,000. And they've saved 40,000. That could be money that they have in a savings account or term deposit somewhere, or even invested with Squirrel. And it could also be partially from their KiwiSavers, so they can unlock their KiwiSavers in this situation. They could borrow up to 95% of the value of the house. So, house value 800,000, deposit of 40,000. They've then got a loan, which is in total worth 760,000. And that's split into two sections. So there's the equity loan that I mentioned earlier of 120,000 done at 9.95% per annum. And the base loan, which is 640,000, which they could take over a 2-year fixed rate period. And that gives them a weighted average interest rate on this example of just over 4%. Okay, I've got a question here from Glenn, so I'll answer this one as we go. Can someone use Launchpad and Bank of Mum and Dad? How does this affect the risk profile? So the answer to that is no. You're going to have genuinely saved that $40,000 deposit. If someone has a genuinely saved sort of 5% deposit, and then mum and dad might kick in a little bit of money on top of that, you've just grown the amount of equity. So that would be okay, but we've got to see at least 5% saved. Why might that be? The reason for it is that savings behavior that they're demonstrating shows us that they've got the ability to regularly commit money away. So that's the main thing that we're looking for there, is that genuinely saved deposit. That's a behavioral characteristic that's really important for us as lenders. All right, so thanks for that question, Glenn. Another question here from Adam. How do you evaluate whether the deposit is genuinely saved? Look, for the vast majority of first home buyers, we'll see regular automatic payments going into some savings scheme or another, whether they're putting it away into a managed fund, whether it's been saved into a savings account, money sitting on term deposit. There's a range of different ways, but that key behavior that we're looking for is regularly putting money aside, which effectively emulates a loan repayment. So hopefully that answers your question there, Adam. There is another question here from Nick. How frequently will you review interest rates for both the base and equity loans? We have to be competitive in the market. So if we think on the borrower side of this equation, our interest rates need to be competitive in order for them to make sense for people to want to use the product. So our partner will review their interest rates regularly, as we will from a Squirrel personal loan perspective. If we think about where interest rates are at in the market today, they are pretty low, as you'd expect. Are they likely to rise anytime soon? Don't quote me on this. Probably not. The Reserve Bank's been reasonably forthcoming in saying that interest rates are going to stay at pretty low levels for quite a while. They want to see a really strong recovery before they look to start raising interest rates. Key thing though is that those interest rates will be reviewed as the market moves. Important to understand on the equity part of the loan, which is the personal loan piece, that loan is locked in for that interest rate is locked in for 5 years, both on the borrower side and the investor side. So hopefully it answers your question there, Nick. Thank you. Let's clear that one through. There's another question here for Peter. Has there been an observable, if I can pronounce that one, rise in rents since the new government regulations? Too soon to tell, Peter. Too many moving parts there at the moment. Anecdotal evidence suggests that some landlords are looking to put their rates up. Whether they can do that across the market, who knows? Because equally, I hear other landlords saying, well, actually, interest rates are really low. I don't need to put my interest rates up. Got lots of equity there. The loans aren't too bad. So I think different landlords will be in different positions. So not sure I can give you more data on that one yet, Peter. I think you'll need a few more months before things start playing out. All righty. So I've got a question here from Josh. I'll keep going on questions. I've got one more slide to go after this one. So I'll have a go at these questions and then I'll jump on to a bit more about what this means for investors. So Josh has asked, how are you determining the value of the house to lend against, or is the purchase price used as a figure to then dictate LVR? Yeah, really good question, Josh. So a couple of points here. The first one is we'll take the sale and purchase agreement as the starting point. We'll then use, there are a couple of valuers in the market that will provide a desktop valuation. We'll look at that desktop valuation from one of the providers in the market. If it's the valuation on that house comes in at a similar level to the sale and purchase agreement, then we will take the value of that house. If the value of the sale and purchase is well beyond what that desktop valuation suggests, then a registered valuation may be required. So hopefully that answers your question there, Josh. Thank you. Righty ho. Another question here from Greg. So you'll base this solely on proven bank documented savings habit showing 5% value saved over an appropriate period. I think one of the items I didn't mention is KiwiSaver. So people, KiwiSaver in some respects is a forced saving regime, which does show behavior of money being saved. So it's not solely about what they've saved into the bank. For the vast majority of first-home buyers today, they do have some money in KiwiSaver, which does demonstrate some of that behavior. So we're looking for evidence. That evidence could be in a range of different ways. As I said, it could be savings at a bank. It could be an automatic payment that's going into a managed fund. So hopefully that answers your question there, Greg. Feel free to drop in a follow-up question if you like, if I didn't quite capture that one for you. All right, question here from Nick. Based on Squirrel's experience, how many of these loans are you expecting to write every month? What's the latent demand? All right, good question, Nick. So in the last 10 days, we've seen the best part of 300 applications from first home buyers that have come in since we announced Launchpad. Of that group, some of them will fit the Kaianga order scheme. And so if that's the best option for them, then we will offer that to them. We've also seen a group come in that actually have, maybe a 15 to 20% deposit saved. And that group is likely that they can get funding through a bank. So we'll direct them to a bank because the loan will be cheaper by going directly there. We've also seen some people who are inquiring, they don't really have a savings track record yet, or they might only have a very small deposit. So we'll be talking to them about how they can continue to build their deposit and at what point then they might be ready. And then we get to the group which might be Launchpad. So based on what we've seen so far, I think from those applications that have come in, we might see 10% of those convert. So, let's call that 30 loans from what we've seen in the last 10 days. That group, though, won't convert all tomorrow. Some of these people won't have realized that they can now buy a house. So they've got to go out, find a house to buy before they can get started. So I'd expect that we'd see those 30 draw down over the next 6 to 9 months, assuming that, my maths of 10% conversion rate for Launchpad plays through. So what does that equate to in Launchpad loans? If we assume an average value of, say, 100,000, then that would mean about 3 million worth of loans roll through. For perspective, in our 5 to 7 year personal loan investment queue today, we've got about $1 million waiting for loans to come through. So we can see about 3 million coming through from Launchpad from what we've seen in the last 10 days. We'd expect word of mouth is going to do a really good job for us to have those loans roll through on an increasingly fast basis as we get into it. So I would say we've got our first loan that's approved. Settlement on that, I can't remember the date off the top of my head, but the first one's gone through that process. I would say 6 to 8 weeks from now, we'll see a lot more loans starting to roll through. All right, hope that gives you an idea there, Nick. Thank you. What I might do is I'll jump to my next slide. We'll go through that, and then I'll pick up the other questions that come through. Okay, so from a Squirrel investor perspective, 7 brief points to, how many? Counting, 6 brief points to talk through. So first one, our Squirrel investors have the opportunity to invest in the equity part of the loans for Launchpad. These loans fit the existing 5 to 7 year personal loan investment class. So there's not a new investment class you'll see, it's the existing 5 to 7 year personal loan investment class that these loans will fit into. The loans are secured by a second mortgage over the property. That's definitely not as strong as a first mortgage, but you sit in behind the other lender who has the first mortgage. The borrowers are making principal and interest repayments. So therefore our investors will see principal and interest returned to them. And the return that they'll see is 7.5% per annum, fixed for that 5 years. As I said, interest rates may move over time, but for the foreseeable future, I would see the 7.5% return being available, and that's on a fixed basis. All of the loans or investments in this 5 to 7 year category have the support of the Personal Loans Reserve Fund. I won't labour that point around the reserve funds. Feel free to ask questions on it or have a look on our website about how the reserve funds work. But they effectively take the credit risk, largely speaking, away from your investment. And last but not least, the secondary market is available, and you may well have seen that we've removed all the fees from using the secondary market over the last few months. And we're seeing a lot more activity in that secondary market as a consequence, which I believe is a good outcome for investors in creating that liquidity. There we go. So that gives you a really good run through of what that means for investors, I believe. Right, I'm going to get on to more of these questions now. So a question here from Rod. Does this product have the same requirement from the first home buyer government plan? You need to be on KiwiSaver for at least 3 years. In my case, you only joined KiwiSaver 1 year ago. So from Squirrel's perspective, you don't need to have been saving in KiwiSaver for a long time in order to access it. I'd need to check the exact rules if there are anything on the KiwiSaver plan itself about how long you've had to have saved for, but there's no restrictions on the Squirrel side. So I'll look into that one, Rod, and see if I can get an answer back to you after the webinar. All right, let's move on to the next question from Scott. Is the financial interest in the property held with Squirrel? So the answer is yes. However, it's a second mortgage that Squirrel has on the equity part of the loan. Our partner who's funding the first mortgage, or the 80% portion of that loan, they have the first mortgage. Okay, so there are lots of scenarios that play through. So let's say we've got a loan for 100,000 on the equity side of the loan. The borrower defaults. Chances are the first mortgage will almost always clear all of the debt that they're owed. On the second mortgage, it could vary from we clear everything depending on where house values have gone. So, there's a full return in a default situation back to the reserve fund, or it could mean that there is a loss that could be taken in some way, shape, or form. Having the second mortgage means you sit in behind that first mortgage. And so if I carry on with my example, let's say there's a $640,000 first mortgage. We've got a second mortgage for $100,000. The loan defaults, goes to mortgagee sale. There's $740,000 in loans owed in total. Let's say there's $700,000 returned from the sale. Then that would mean that the reserve fund would take a $40,000 write-off at that point, and would get back $20,000, which would go back into replenishing the reserve fund. So is there risk in these loans? And the answer is yes, there is. And that's why they're priced the way that they are. It's expensive for the borrower. We're reserving at a rate that's about double what we expect to see over time. So our modelling, which we've looked at, Standard & Poor's produced some data on low LVR loans. We've used that, which suggests that the sort of write-offs that you could see over time might be at about 0.5% of the portfolio. We're reserving at 1% into the reserve fund. So we're going twice what the experience has been over the last 20 years on those low LVR loans, which we think is a reasonably conservative approach to reserving. All right, so Scott, hopefully that answers that question there. Thanks for asking that one. Question from Greg. Have you extended real life example to demonstrate second year repayments versus typical rent costs, allowing for added home ownership costs, rates, insurance, etc.? What we find in I'd say Auckland and probably Wellington, is it can actually almost be cheaper to have a mortgage than it can be to rent, depending on where you're renting. And there's lots of different scenarios. If you're renting in Hawke's Bay, it's going to be cheaper than renting in Auckland, for example. So there are very clearly cases that we see today where it's cheaper for them to have a mortgage than it is for them to pay rent. So if they've been meeting their rent payments, then the mortgage repayment should be no trouble for them. Thanks for that question there, Greg. Sorry, I should also add just on that point, when we're assessing the borrower, we are allowing for rates and insurances and all those other things that a homeowner experiences along the way, and making sure that they're not going to live on rice and beans for the next 5 years of their life. So we are taking a reasonable approach to thinking about the costs that those borrowers are going to have once that loan is drawn down. Thanks, Greg. Okay, question here from David. Given these loans are generally higher value than personal loans, a downturn in the economy and housing market could see the reserve fund wiped out. Is that possible? There is no guarantee on the reserve fund. From a Squirrel investor perspective, you're trusting that we're reserving the right amount against each loan to make sure that on average, the reserve fund has more than enough money to cover the expected defaults. So if we think about the coverage ratio of our personal loan reserve fund today, that coverage ratio is over 4%. If we look globally at other peer-to-peer lenders who have a reserve fund model, then 4% is an incredibly high number. Most operate in the 1% to 2% zone from a coverage ratio perspective. So that suggests that we're reserving at a pretty high level, a pretty conservative level based on the risk in the portfolio. If we look at the write-offs in our personal loan portfolio over time, the write-off rate is around 1.3%. Okay, so that's the default rate on the portfolio. These loans, the Launchpad loans, we believe are lower risk than the average in the portfolio today. Okay, so introducing Launchpad actually, on average, lowers the total credit risk that there is in the portfolio based on our modelling. So if house prices tank, that's not necessarily the end of this, or things could be wiped out. the stat or the one macroeconomic factor that I'd be paying much closer attention to is the unemployment rate. That unemployment rate, if we were to see that soar, and let's say beyond 10%, at that point, you know, we'll be looking pretty closely at modeling what's likely to happen. It's that unemployment rate, which is the key macro stat that you might want to keep an eye on in your own right. If we look at what happened for personal loans last year with COVID rolling through, at one stage we had 7.5% by value of the personal loans that were either on hardship, so they weren't making loan repayments, or they were in arrears in some way, shape or form. Yet the personal loan reserve fund actually grew during the calendar year last year. So if we take from January last year through to December, the reserve fund actually grew, which makes me believe that we're reserving at the right level. Over the life of a Launchpad loan, we're reserving almost 2% of the loan value on its way through. So hopefully that answers your question there, David. Happy to take follow-ups on that one. Question from Zai: have you considered any regulatory action against interest-only loans? Are you assuming that the Launchpad loan won't fall into any potential regulation? Look, you never quite know exactly where regulation is going to go to, Zai. Tough situation, but we can only respond to the information that's in front of us. If there are some restrictions on interest-only loans, could that have an impact on us? It's possible, but I'd need to see the regulation before I could comment any further on that one. One of the interesting things today is that Squirrel is regulated by the FMA rather than the Reserve Bank. So we aren't exposed or aren't impacted by the LVR restrictions that the Reserve Bank has introduced for these loans, albeit we've chatted about this with the Reserve Bank to let them know what they're doing, what we're up to. And they raised some eyebrows, but they didn't seem overly concerned. They might get a lot more concerned if all of a sudden there's a billion or a few $1 billion worth of lending in this space. We've got a long way to go before that's the case here. Thanks for that question, Zai. Next question, can you tell us who your investment partner is? Yes, and if you look closely on our website and you look at the loan documents, the answer to that is Resimac. So Resimac are a second-tier lender here in New Zealand. They also exist in Australia. In fact, I think they are one of the largest second-tier lenders in Australia right now. So they're a really strong partner to have on board, and we're very happy to have them. It would be worth noting, though, that this is a Squirrel product and it's exclusive to Squirrel. Squirrel branded, our borrowers will see Squirrel, our investors see Squirrel on these loans. However, that first mortgage or that 80% base loan will be in the name of Resimac, and they hold the first mortgage. So thanks for that question. Not a secret, but it is a Squirrel branded product. Okay, I'm conscious we're running into 1 o'clock. I did say I'd stay and answer all the questions, so I'll keep going. For those of you who have had enough, feel free to drop off. But I'll keep going on these questions for those that can stay around. Next question is from Peter. So what would happen in 6 months, say, when the loan requirements outstrip investor funds? So a couple of things. First one is for Squirrel ourselves, the way that we manage settlement on our home loan and business property loan products is we have a warehouse facility with one of the major trading banks here in New Zealand, and we can use some of those funds to fund these loans. So we will only ever send through the amount of money or lend out the amount of money that we're confident that we have available, whether it's through retail investors or using this receivables facility that we have in place with one of the banks. So our treasury operation will be managing that pretty closely to make sure that we can settle on the date that the borrower needs to settle on their loan. Thanks for that question, Peter. Next question, how does Squirrel make its money per transaction? Yeah, so if we talk about the waterfall here, so I mentioned that on the equity loan, the borrower is paying 9.95%. The investor is earning 7.5%. We're reserving at about 1%. So if we take the waterfall, we'll say 9.95 is what the borrower is paying. We'll take the 1% reserve off that, which brings that down to 8.95. And then there is a squirrel margin there. So we take a 1.45% margin on these loans, if that gives you an idea of where we generate our money. We also earn some commission from Resimac on the 80% portion of that loan. There is a $1,000 fee for this loan, but that's absorbed completely by costs. In fact, it probably costs us slightly more than that as it stands today, and we'll reevaluate that fee over time. But yeah, so there is an upfront establishment fee for the borrower of $1,000, but really that only covers costs and probably doesn't cover all of our costs at that point. So thanks for that question. Next question is from Luke. Could two people go in a partnership to buy a house if they have 5% each? I think the answer to that is yes. You'd need to be pretty solid solidly in relationship or in partnership in order to do that. So the answer is yes, I believe in that situation. We need to investigate each situation on its merits. But yeah, we will certainly look at situations like that. The vast majority of examples that we do see, though, where it's two people who are in a relationship in some way, shape, or form. Thanks for that question, Luke. Question from Josh. Is the reserve fund an annual figure? You have 1% reserve fund per year and get replenished for those loans versus 0.5% annual default rate from S&P that you mentioned. The answer to that is yes, Josh. So over the life of that loan, so over that 5-year period, we'd expect the total amount reserved against each loan to be about 1.9%. I can't give you a definitive on that because the prepayment rate that we're likely to see will impact that amount as well. So, we'll see some loans repay faster, which means the total amount that's paid into the reserve fund will be less in those situations. But in essence, we're reserving at 1% per annum. Annual default rate of 0.5% per annum is what we could expect based on the S&P or Standard & Poor's data. Thanks, Josh. Next question, can a mortgage broker external to Squirrel get their clients this lending product? This isn't the first person to have asked this question, albeit not on this webinar. The answer is no. We've made this exclusive to Squirrel to begin with. We've invested a huge amount of time, money and effort to get this product to market, including developing the investor funding and all those sorts of things. So to begin with, this product will be exclusive to Squirrel. Might that be exclusive forever? Maybe not, but certainly for the foreseeable future, it will be exclusive to Squirrel. Thanks for that question. Question from Greg. Any early repayment fees or early faster Launchpad repayment by the borrower? No. So for the borrower, there are no costs to prepay early. Either, if they make an extra $50 a week payment on the loan, or if they come in and they manage to pay that, they get a bonus or something and get 20 grand and they want to drop that on the loan, then we're happy to see that come in. For investors, that means you may see early repayments come in. We expect that we're going to have enough loans for you to invest in that you can just keep reinvesting that money, and the wait times will come down substantially from what they are today in that 5 to 7 year personal loan term. Thanks, Greg. Question from Glenn, is the loan transferable over properties? Good question. I'm going to say the answer will be yes. However, we'd need to make sure that the loan still fits the parameters. Okay, so it's quite a tight envelope from a credit perspective that these loans need to fit into. So we'd need to make sure that whatever the new property was, the loan still made sense and still fit into the envelope. Thanks, Glenn. And question from Robert. Will the borrower pay 2 loan repayments per month or 1? So for each of the borrowers, we'll work with them to figure out whether they want to make fortnightly or monthly repayments on the loan. That'll come down to their pay cycles what we see is most people are earning their PAYE income on a fortnightly basis, and we'd expect most of the loans will have a fortnightly repayment cycle attached to them. Thanks, Rob. Okay, looks like I have got through 21 questions, which is pretty good going. We're coming up to sort of 35 minutes worth of the webinar today. I can see the number of participants has dropped slightly. Now, there is one question in the chat. Let me check that one. I like your McDonald's baseline reference for Metro. Yep, that seems to work, funnily enough. So we'll run with that one. So thanks for that, Adam. Good one. All right, thanks very much, team. We'll end there. See you later.